Hello and welcome to this week's instalment of Nucleus Investment Insights. We have another special guest this week in Stephen Mitchell, who is co-founder and CEO of Melbourne-based property finance company Oak Capital and specialty lender Resicom. In today's interview, we dive into Stephen's take on the current state of the Australian property market, some reflection on the past and his views on where he thinks it's headed.
Yep, so we've got Stephen in today from Resicom. One of the key investment factors we're looking at the moment is the Australian property market and really trying to see whether is that going to hold up or not. And so we've seen in Perth, as unemployment rose, that despite loose lending conditions, the value of property still continued to fall. And we've also seen that post-Royal Commission, when banks all pulled back on their lending, we saw property prices fall. So we're very keen on looking at this element of the market. And what we're really trying to get him in for today is to give us an on-the-ground view of what's happening at the lending market. Now, he's what you call a third-tier lender. So banks being first tier, there's a bunch of second-tier lenders, and he's sort of lending at the more bespoke, and I guess people who have some pretty special needs who can't get lending elsewhere. And we thought this is a great area for us to look at because this is where we'll really see some of the pressures and some of the strains that are happening in terms of the Australian property market.
After the interview, we'll then look at some of the wider investment implications that these themes can impact on how we invest money every day here at Nucleus Wealth. So join Nucleus Wealth's Head of Investments, Damien Klassen, and myself, Tim Fuller, as we learn more about the current state of Melbourne's property market from a well-respected mortgage industry veteran who sits right at the coalface. I hope you enjoy. Today on the show, we have founder and CEO of specialty lender Resicom, co-founder of mortgage fund company Oak Capital, and veteran of the Melbourne property finance world, Stephen Mitchell. Welcome to Nucleus Investment Insights.
Thank you very much. Good to be here.
So I thought just for our listeners, if you wouldn't mind just providing a little bit of background about yourself and also obviously the companies that you're in charge of at the moment.
Sure. So look, I set up Resicom in 2006. I came out of a company called Latrobe Financial. Resicom has been set up as a mortgage manager. So essentially we rebrand other funders' capital, and it's always played in that second tier space. So everything outside of bank world is pretty much where we sit. We deal with mortgage brokers that are either underserviced by other lenders or they're not sure how to get a deal done outside of the bank world, because the majority of brokers out there, 95% of what they write previously, it's changed a bit in the last couple of years, but was all bank debt. So as soon as they got a no, they didn't really necessarily know what to do with it, and that's where Resicom played. In 2013, I co-founded the Oak Capital Mortgage Fund, which is a private lender essentially, sitting just above the second tier players like a Pepper and a Latrobe Financial, and lending up to 12-month deals. And those loans are matched by investors, generally high net worth investors, that match and fund those deals and get a rate of return secured by a mortgage on a property.
Okay, yeah, sure. And so I guess given that sort of the breadth of experience and having and starting the fund back in 2013, was it?
The fund in 13, yep.
If you wouldn't mind just sort of setting the scene, perhaps, and we've sort of seen the big uplift and then the changes in Melbourne property prices, and how's that sort of affected you and your fund? Yeah,
look, I think there's two sides. Obviously, we have a lending side of the fund and then the investment side of the fund. So from a lending point of view, it is quieter now than what it's ever been, right? And which is an interesting state because a lot of people think it's really busy out there. But from 13 onwards, there was, I guess, post-GFC correction in the private space. Pre-GFC, there was this, every man and his dog was a developer, and every man and his dog was a private lender because it was all easy to do and everyone did it. GFC cleared out a lot of that. And since sort of 13 onward to call it probably 17, even early 18, it was a good time to be able to lend. Property market was going up. It's pretty easy. Obviously, there was regulation, but the regulation that's been playing on in the lending market has always been heavily regarded the regulated space. So mum and dad borrowers, home loan lending. Where we lend is all business lending. So we've always been outside of that regulatory space. So that area has been relatively easy to lend in. Gaining investors as a new fund has always been an issue because you need to build trust with your investors. But over the years, obviously, we've built that up with no investors ever losing a cent of capital. But in the last probably 18 months, there's been a seismic change where we've got investors wanting to get a yield. So you've got more investors than you've ever had trying to get money into the market. And then you've got borrowers actually reducing, and given the property values coming off, which they came off quite substantially in 18, there's been less ability to borrow. Our valuations are coming lighter. Your offers are less. There's less loans moving out, but you've got more money than ever before. And of course, those investors are hounding to try and get their money out, and they don't always want to take less yield either to do that. And one thing we're very solid on is that we can adjust pricing on a loan to get money out and get a deal done, but we will never adjust our LVR. Our LVRs don't change. Old school private lending, 65% on a house and downward from there, subject to asset class. But given this yield chase and the amount of investors out there, we've also seen a bit of a pre-GFC event occur again, where a lot more private lenders. There is a heap. Every single day we see a new private lender, we see a new letter of offer, because all these ex-bankers or brokers have got these high net worth investors. All of a sudden, they're not running professional funds, and they just want to get money out, and they see there's a really easy way to make some money and clip a ticket with some fees. And we feel that's going to become problematic. We thought it was going to become problematic already this year with the downturn in the market, but I think the election saved everyone for a while because the market stopped necessarily going down and it's bubbling along a little bit. But sooner or later, if it comes off again, we're going to see a lot of investors potentially get a bit burnt, which would be very unfortunate, because we are losing deals to private lenders who are breaking the old school rules. They are lending bigger LVRs, low rates, there's no margin in there. And if you actually speak to some of these newly formed small entities and actually talk about what happens when they default, who's going to pay the bill to go to court, it's a whole new question that they haven't really thought about.
They haven't thought about it.
And little mum and dad investor might need to start stumping up $50,000 checks.
Wow.
So it's a very interesting market that's gone from being quite stable and able to grow at a decent rate to now you have this pressure point of capital, but you've got to be very careful to manage that, because it's very easy to lend money, you've got to get it back. And that's where we're just happy to sit by and ultimately write the deals that we get at the moment, and not be too aggressive. Other people buy them.
So I guess as the Royal Commission started and we saw these clamps come down on the major banks, I guess that's where money started to flow to I guess other lenders. Is that sort of, or you're still picking up sort of through that 16, 17, 18 period, there was other people popping up or new competitors popping up at that time?
Yeah, so I think there's been a number of events. Obviously, the Royal Commission hasn't helped the banking space, which of course has pushed a lot more borrowers into that second tier, and then out of the second tier into the private world. So we generally refer to it as 3 tiers. So banks, second tier is like a La Trobe Financial, Pepper, Liberty, and then third tier being private investors. The second tier only has so much capacity to take on the bank debt. Right. And when the banks fund pretty much every loan in the country previously, and then all of a sudden the second tiers have to take on hundreds of millions a month more in advances, they start also getting better quality deals than they used to get, because they're doing all these bank quality loans. So then they push everything else out the next door to private. And normally it's okay, so there should be heaps of loans. And previously there has been, as this has eventuated from probably 16 onward. But also it gets to a point where these borrowers, if the economy is not as strong, and we're talking business borrowers, they just don't necessarily want to borrow the money, right? That extra, a lot of the time when we lend money, they've got an extra thing to do with their business. They want to grow their business. They want to get the capital. Now those borrowers generally go, I'm just going to wait. So the borrowers that do go ahead are the ones that are under a bit more pressure. Because the ones that are doing it just to advance themselves are going, I'm not going to pay that extra rate. I'll just wait till maybe I can get a loan at a bank later. And they sit on their hands a bit. So there's so many different factors that have been playing in. And then, of course, there's also the other ones that want it, but their values are coming down. You know, their house that was 2.5 million is now 1.8. And they have real drops. You know, we unfortunately had to repossess and sell a property outside of Parramatta last year, and that had dropped 35% on the valuation in an 18-month period. And they were real big drops, because certain markets went through the roof at a great rate of knots, and they come off at the same. So there's so many different elements that have controlled it. But the Royal Commission obviously has affected the banks to no end. And even before the findings, they were already putting everything in place, getting ready for the findings. And the developers is a whole other world again, because the banks just aren't lending pretty much to any developer. And there's, again, only so much money in that second tier space.
And so most of those, do you think the second tier space has, how much do you think it's expanded in terms of the So I guess have they got the same? You think they're facing the same pressures as you in terms of lots of investors coming to them saying, "Hey, can you give me a yield on anything?"
Yeah, I think if we refer to a Latrobe, who obviously got bought by Blackstone,
Yep.
They're one of the biggest and best names in the second tier space. They operate a mortgage fund as well, but their fund growth has been something like, I can't quote it, but about 50 million net a month. That's enormous.
Yeah.
Right? Now they're set up properly and they can run that show, and they've got a big backer behind them as well. But their settlement volumes have gone in a couple of years from circa 100, 150 million a month to 400. Like, that's a big jump.
Yeah.
And then you've got the other guys around the edges that have all done on similar levels. So that market can take on a fair chunk, but still, even if you call that 400 million a month and someone else doing 200 and 300, that's still nothing compared to what the banks
are doing.
normally write.
Yeah.
The numbers just blow your mind. So.
Okay. Yeah, sure. Just get a little bit of an understanding, I guess, and just quickly, and you spoke before about primary and secondary and then private. Just for the listeners at home, I guess, obviously there's a difference in the desired or targeted rates that you sort of get. So everyone's pretty familiar with what a standard, vanilla home loan would be.
Yep.
Do you mind just sort of covering off on what would be expected now in the other tiers in terms of percentages?
Sure. So I guess in our space, being a mortgage fund, so we are a contributory mortgage fund. So every single loan is funded by an investor or a group of investors.
Okay.
So there is no pool. So they don't just put their money in and get a yield. So every loan also does have its own characteristics, and therefore the rates can change. Generally, our returns are 6.5 per annum through to potentially 10 per annum, depending on the asset, depending on the borrower's credit background, the speed of capital, and different things that are out there. But that versus the TD that might be now 1.5 is a big change. And I think there's an element of investors out there that were somewhat comfortable at that 2.5 to 3% money they used to be able to return on bank funds, even on a quantum of money that was still a decent amount potentially to live off. But at 1.5, it's going to start make you look around.
You got to look
You
elsewhere.
need alternatives. Are you going to buy high divvy returning shares, or are you going to start looking at mortgage funds? And that's where all these different investment grades are coming. Second tier groups, other funds are returning 4s, 5s, 6s.
Yep.
And as I said, so probably up to that spectrum of 10 is quite reasonable.
Wow.
And it just does come with different risks, obviously, associated with the investment.
And
From our point, the risks are, if you're on a first mortgage on a house or a first mortgage on a block of land, you're going to get a different return. Now, the element of risk may not change much because the land might be with 50% ratio, the house might be at 65, might be both easily saleable, but just given its land, you can charge a higher rate and it's a higher return.
Okay.
And I guess in terms of, for our listeners, there's obviously a different spectrum of risk within all these, as you said. Like it's a chalk and cheese risk in terms of these, where the danger is often, as these things are sold, as they're often sold as, I'm sure you see in the private space as well, as, hey, take your money out of your term deposit, which is guaranteed and got all these extra benefits, and the banks fall over and the government still step in and give you the money, to an 8% mortgage through us, which you only need a few bad things, a few things go wrong, and all of a sudden the 8%'s gone. That stretch for yield can really snap back, and it's just, to me, that's sort of in the same basis as buying some. You might think they're not as risky as shares, but some of these things are as risky and more risky than shares. Yes.
Absolutely. Subject to who's writing them, there's a different scale of risk from a term deposit.
Yeah.
So a term deposit guaranteed by the government under 250 grand is as good as it's going to get, but therefore you're going to get your rate.
Yes.
And I, not to give advice and not a financial advisor, everyone should be spreading their money.
Yeah.
If anyone, and I've had numerous meetings with people that may be in their 70s and they just all of a sudden want rate, and they start talking about giving you all their capital.
Yeah.
The first one to say, hold on, that's not a good idea. Yes. Not that I'm not backing ourselves that you'll be fine, but we just don't want all your capital because it's going to keep you awake at night, right?
Absolutely.
You need to, my thoughts are, this sort of investment, you need to be able to understand. If you don't really understand it, you shouldn't be doing it. And you need to, it can't break you if you do have a version of a loss.
Yeah.
If that's going to be the end of you, you shouldn't be investing in this sort of stuff.
Yeah.
But to be fair, you probably shouldn't be investing in anything that has higher levels of risk. It's all, you just got to wait it out, don't you, and put it across the spectrum. I guess with our element that it is a mortgage, it's a first mortgage, and you get to know the asset specifically. You're not just putting it in a fund and hoping that it's ran properly. Does add quite a few. It does take away some of the risk factors we feel. But of course, there's always elements of risk. Your house can drop in serious value. There could be fraud. There could be a range of things. You can mitigate it as best you can, but there is risk. Yeah,
absolutely. So that's stepping back to, I guess, more about the market. So I guess what are the areas you'd say that are we're still seeing a lot of tightness and people really struggling to get loans? So as you mentioned developers, so maybe we start with developers.
Sure. I think developers is the number one. There's not many people that are finding it harder to get capital than developers. Even really well-heeled developers will not get capital through major banks. The one thing that goes in your favour for a major bank development finance is a very good builder, and the builders in many cases like ANZ and a couple of other majors have specific builder lists. If your builder is not on that list, they will not advance capital. It's not even worth having the conversation.
And Stephen, when you say development, so what sort of size development, just to sort of clear that up?
Generally, we're not talking mum and dad under 3 units, right? Okay. So up to your sort of 3 unit stuff that you'll normally get a home loan style transaction done through a bank if you tick all the boxes. But outside of 3 units, it becomes more a commercial scale development. And then the banks are generally not playing, and they all have their own, obviously, their own niches. But I believe it was ANZ not long ago had if it was under 10 million, they weren't even interested. Right? So you've got to be over 10 million in borrowings. You've got to use one of their certain builders that they've got approved. And obviously you need to have a history with the bank. So if what we saw pre-18 tightness or even late 17 when all this development stuff started getting very tight was that if you had a bit of equity, you could go do development. Every man and his dog became a developer. Everyone's watching the block. Everyone thinks there's heaps of money in it. That's great. And everyone's doing it. But the problem is when the times change slightly, you can no longer get your capital. And that's where the banks are. They pulled out. Essentially, they are out of the market unless you're super solid. But the majority of people that we see aren't that experienced. They're not necessarily that solid. They may have other assets around them, but, have they done a 40 unit build before? No, they've done 5 and they think they can now do a 40. And that's a problem. They just jump to hyperspace because they had one good project. And they all now flow through to that secondary space. But again, there's only so much money in that space, and those guys are getting the ex-bank clients. So if you were never a bank client wanting to get your development finance and going, okay, I know I can get a loan and pay 9% for my loan, you're probably not going to get that loan because that funder is getting the guy that used to go to CBA. So they're getting the really good quality development deals. So then they're off to private world, and in the private world it could be a 10 to 15% interest rate.
Wow.
But the drama we see is a lot of these guys already own a site. So they're half pregnant, right? And they've got to do something. And like most people, they have pride. And they don't just want to sell and get out and make their $100,000 and move on and just go, that was not a good idea and it was a bad time in my life.
Well, it's not making the $100,000 that worries them. It's a loss of the...
It could be a loss, but we've seen plenty of deals where they had good offers to get out of deals and they've stayed the course and they've gone under. Right? They should have just got out because they can't get the capital finance. And then if you're paying 15% and your feasibility was done at 6.5%, there's not a lot of profit left at the end of the game, if any. And then, of course, you have a market that's dipped. You have a pre-sale that falls over. You're in trouble. So if you're not a super well-heeled developer, it's not really a good time to be doing it. And there are certain funders out there, not the major ones, obviously, that are looking at these as opportunities. They just do. They look and go, oh, if it falls over, there's a bit of money in this for us to finish it off and make a heap of money out of it. Obviously not reputable, but that is out there. There is an element of that in the market, and people need to be very careful of that as well. But developers by far are the hardest ones to get away.
And so the second tier, are they lending, you think, more to developers than what they used to, or are they just sort of, they are? Okay, so they're not sort of stepping back as well and saying, well, we don't really want to go there. The banks are sort of going, we don't want to go there unless you're big. The second tier is going, we'll take the
We'll take all the good stuff that you guys don't want, and they'll also just be tight on it. So they've put up their rates a bit, because they go, well, we can.
Yep.
And they just drop their LVRs, and they now start asking for a few pre-sales. Some of these lenders previously would lend development that would say, look, no pre-sales. Great, we'll do the deal. Now they're going, well, actually, we don't need to say that. We can get a few pre-sales, so let's do it. It's their market, right? And people will bend over backwards to get the finance. So they will go with them. But once you fall out of that, then you're going to pay serious price. And again, it's also, we always tell people in private space, it's not about just what the deal looks like day one. You've got to look at how does that lender operate through that loan? The day you miss one payment by 24 hours, what's going to happen to you? The more reputable players will support you, and you'll be able to pay a week later, and away we go. And it's all happy days. There are certain other lenders that will go harder on that, and you need to be very mindful of who you're dealing with. Just because the rate might be 0.5% cheaper over here, it may be better off pay that extra 0.5.
With insurance.
Yeah, exactly right. The kind of insurance. So that's sort of what we're seeing, but they are, a lot of that volume increase in secondary space has been to development finance. I would suggest it's starting to be looked at again with a couple of decent collapses of Stella and a few other things going on.
You mean from a regulatory perspective?
I don't know, from the internal lending policies,
okay.
It's going, how much development do we really
Yep.
want to have right now? It all depends on what you think the property market's going to do. If it's going to keep staying and going up, then you can be pretty happy lending.
Yep.
If you feel it's going to pull back and you feel there's a lot of cranes on the city of Melbourne as you drive over the bridge, you may want to consider, pulling in a little bit. I don't see the funding for developers changing in the short to near term. It's going to be very, very tough.
Yep.
The other funding areas that are hard, which have always been quite difficult for the last number of years, apartments in general. Private lenders don't really want them, especially the dog box stuff under 50 square metres. It's very hard to get funded. There's so many of these things now. You've got 400 or 500 apartments in a building. It's not the most appetising thing to lend on. So unless you're a bank client.
Yeah, I was going to say, is that sort of predicated on the fact that the end purchaser is now facing some restrictions on the sub 50 square metres?
Yeah.
So that the final financing element is actually starting to tighten up. So that's blowing back through into the development of those.
Well, that blows back to developers. So that's why a lot of the banks, etc., have major pre-sale requirements. They need more than the debt amount sold, because you've got to allow that a certain amount are going to fall over.
Yep.
They're just never going to come through. Also, a lot of pre-sales, especially back in the day, were all $1,000 deposits.
Yeah.
They didn't really mean a lot, but they got a pre-sale. So, as a lender as well, and as a private lender, you need to look at who's going to take you out of a loan, right? And second-tier lenders have much heavier restrictions on asset classes than what the banks do.
Right.
The banks can lend on pretty much anything if they really, really want to, because they've got deep enough pockets. Second tiers will lend restricted LVRs on high rises, on apartment size, certain things like that. And then as a private lender, you've got to be mindful you need to be below all that, because your out is for this person ideally to refinance.
Yep.
Your out is never that you want to sell.
Yeah,
that's
right.
that's not the game.
Yeah,
you want them to leave and be happy and move on. But if you're lending too much, they can't get out.
Yep.
Right?
You're flooding the back end of the pipe.
Exactly.
Yeah. Right.
And then you've got an exposure issue in these apartment buildings as well. You need to be very mindful of. If you've got 400 going, how many do you want to lend on? And what about the one next door and the one going up a week later? There's just so many extra elements of risk with high-rise apartments, inner city apartments. Well, we saw that with Docklands years ago. So that's another area that's pretty hard. Financing against standard resi, good commercial. Well, commercial's been quite solid through the last couple of years.
Yep.
Isn't such an issue if the borrowers stack up. Borrower lending is obviously hard in general with the criteria that's on borrowers these days. But really, those assets, developers, development, and apartments are the hardest parts, I think.
Yeah, and standard commercial lending, I guess smaller business commercial lending was sort of seen as. Well, it seems to us that over the last 20 odd years, it's gone from, we'll lend against a business to, no, we'll lend against your house.
Yeah.
Is that still the case, or so because the banks, I guess, are realising that's a bit of a problem now, but is that?
So I think there's a lot of goodwill and a lot of good talk that you always see, and certain banks allocate X amount of billions, they're going to lend a small business this year and all these lovely things. But in many cases, they're not really true business loans, or they're very small. They're essentially a glorified personal loan. In many cases, that fits that pocket of money. A lot of the time, the major banks do really want the security of some fixed asset. So therefore, in many business cases, they just can't access the capital. We've seen a rise now of obviously unsecured lenders that have come into the market, the Prospers, Maulers and certain groups. They have obviously their catches are rather expensive compared to the loan that you thought you were going to get at a bank. But they will lend capital and they will lend it unsecured if your cash flow is high enough to support the repayment schedule. We've also seen Judo Capital, which has started up now, which is an SME lender, who will lend purely on businesses as well. And their whole case is that they're going to go back to old school banking. The banker will go meet the client. If they know you, like you, trust you, and your business sounds good, they may just write the deal. And that's their whole claim to fame is we are not going to be like the major banks. We will do true business lending. It's a space that has obviously suffered and it's affecting a lot of businesses. Access to capital in general is affecting a lot of businesses. Even if you do try and get it against your own home, and we see many loans, even bank world, in second tier world, where clients have got millions of dollars in equity. They just cannot get a loan. Right? Because if your criteria doesn't stack up, there's no more, well, it's your equity, take the risk. It's no, the bank might get in trouble here, so we're never going to lend money. Which just suffocates people's access to capital.
And absolutely, and it's that whole thing to me that from a benefits of capitalist society is you have an idea, you can start that thing up, you've got it in a company. If everything goes wrong, well, look, everything went wrong. People had their eyes open when they went in, and I can go and do something else without having to, without blowing up my life. Whereas when you go, no, you're only allowed to do that if you stick your house on the line. You sort of almost lost half the benefit of that whole. Yes, I can start a company and try something new without risking my livelihood.
Well, just dampens the entrepreneurial aspect of an economy, doesn't it? Where it's got to be an absolute red hot, bet your house on it sort of style of business. Otherwise, it's just not going to get off the ground.
Well, and it's that sad bit as well, where you're sort of saying, well, I've said it before on this podcast, and I'll say it again, I'm sure of many times, but the aspiration of a person sitting in California or something like that who wants to start a new business, or an entrepreneur in different countries is, yes, I'm going to go out and I'm going to start this tech company, I'm going to start whatever, I'm going to make an app, I'm going to do what I'm going to do. Whereas it tends to be in Australia, I'm going to buy a house and do it up and flip it to somebody else. Yeah. That's my, that's my entrepreneurial spirit. And the rest of the people who do have an app or a service or whatever have to actually have a house to back it with. It sort of cuts you into sticks everyone in that corner.
And then you have part of the over-regulation in many cases does hinder that. At the end of the day, you have the lenders that would like to lend money to someone who has their $2 million unencumbered house who wants to start a business and just says, I just need 200 grand. They cannot get it.
Right.
Like, they will not get it through a bank because you need to have the business going already. As a general rule of thumb, you need to show your financials for a couple of years. Right. Well, I wouldn't be asking you if it was already happening. Right? And the fact that many of these clients would say, I'm happy to risk my house. It's 200 grand, it's worth 2 million, I want to do it. You cannot access capital, you just can't. Right? And then the lenders are seen to be the bad guys. If someone else does lend money to that person and it doesn't go well, then it's the lender's fault. So we have this, two-sided issue in Australia where you've got lenders so scared to do anything because they've got it's all their risk, and why did you lend the money even though the borrower wanted it? And then you also have some borrowers who can't get the money even though they do want it. So it's a really tough place, and it doesn't help for businesses, doesn't help for entrepreneurship. It's a concern, I feel.
Yeah. I guess moving, sort of hitting up some of these developers as well. So the guys that are finishing halfway through, are we seeing much of other people picking it up and finishing the projects, as you said, or because I feel like in past ones you see these buildings that just sit there for 10 years or 15 years. I have a distinct memory of World Square in Sydney, which I went through maybe 20, 30 year period of being a hole in the ground while a few people would build something and then stop, and then build something and stop, and then finally had a property boom big enough that it finally went ahead. We're obviously not at that stage yet where things are being abandoned. It seems to be more they're picked up and carried on. Is that?
Yeah, I think currently, given the fallover rates actually aren't that high, we don't have a major arrears issue in Australia as yet, and especially not on commercial development space. If the developers are getting them away and the finance is starting, they're generally not going to fall over because the financiers are capitalising all the build cost in their loan. So if this loan does go pear-shaped, they can complete the project, and they will, because no one wants to be selling a half-finished high-rise.
Yep.
And is that common? Is that where the lender or the bank, for example, takes over and completes the property to sort of close it out?
Is it common? I don't think it's as common as people might think it is. Like the majority of loans will get through that stage. Where most loans fall over is before they start digging up the dirt.
Right.
Where they just can't get the finance, or they've started a basement because they thought they were going to get a loan, which is a very common one, especially in smaller developments, is the very proud borrower who has all this money thinks, I'll start and I'll get my loan sorted. So they start, and then, of course, no one wants to lend on a property once it starts. All banks, all lenders want to fund the project from the scratch. They don't want to come in when the frame's up. They don't want to come in once the slab's down. They're just not interested.
Wow.
You can do it again. It's going to cost you more money, different lenders, more review of the deal. So that's normally where most guys will fall over. They just can't get the capital right now. They've been trying forever, and that's where you'll see sites sitting around being resold numerous times. But sooner or later, someone with the right backing will build it. Once the development begins, all lenders are holding back 100% of the cost to build this thing. And in many of the larger cases now, they've got the pre-sales. Whether they're worth something or not, there's generally some level of solid pre-sale in the deal. And a lot of these pre-sales are now vetted. Banks will vet every pre-sale to make sure it's legitimate. Previously, they all sold to a marketing group in China, and that wasn't worth much either. So you're not seeing them really fall over midway, and it would be the bank, the lender, that will step in.
Yep.
And if they've got the capital reserves, they'll do it. Probably there will be an element of risk, and we feel there's an element of risk. If the market does have another shake and another downturn, it's going to be these smaller consortiums of private lenders that have funded these that will have the problems. Because if you do not have seriously deep pockets, there's only so many you can step in and finish.
Yeah, sure.
Right? And you've got to be able to control it and manage it. The bigger groups are able to do that in a non-disastrous market.
Yep.
But I don't think we see that as much as people suggest.
Now, we're sort of moving through this sort of pig in the python part where we had this massive amount of apartment building, which is now the approvals have all plummeted now, but we still have the completions sort of coming through. Are you seeing that? How much is that affecting, I guess, apartment prices? How much of apartment prices is people concerned about, cracks in buildings and people not lending and all that type of stuff? So how much of it's sort of a demand issue, and how much of it is there's just so much supply hitting the market at the moment?
It's an interesting question because you have obviously the Opal style fear,
yes.
Which is running through a lot of apartment buildings. You actually got a scenario yesterday where the loan was on an apartment building and they've been hit with a special levy, which is in the same sort of area.
Wow.
And of course the question is, well, who's going to buy this thing? Who wants to carry that ongoing levy for the next 5 years to repair it? And then is it still going to be still over 5 years? But is it still going to have problems? So there is definitely a negative sentiment around apartments at the moment. And even if you look at, I think it was Prima Pearl the other, which is a quality building in Melbourne, people start coming out saying there's noises in the building. Anyone looking to buy in that building is going to stop.
Game over. Yeah.
So apartment prices are not generally increasing. If anything, they're going marginally backwards. Your really good quality older stock stuff, we feel, is generally okay. Like your stuff along St Kilda Road, decent bigger apartments are okay. Are people getting concerned on the new stuff? Yes. Even the 108s and that of the world, people are starting to worry because there's all noise. The facts are these buildings do make noise. If you're going to buy a seriously high building, they make noise. But of course, what's put in media does make it sound a lot worse than what it probably is. But it is having an effect on all the owners in those properties. It is having an effect on the lenders because they are now starting to look into it. You've got the cladding issue, which is probably an even bigger problem. I think a lot of the noise in the build structures, the fundamental problem, I don't think is as big as what people suggest, but the cladding apparently is enormous. We have property valuers now starting to make mention of it in their reports. If they feel there's a cladding issue on the building, because if that gets picked up and there's going to be cost, and if it's not funded by the government, it's dramatic. And that's on thousands of buildings. But I saw an article last night on the news, about 170,000 apartments in Melbourne since 2000 that were built.
With the cladding?
170,000 buildings, apartments in general, which is an enormous amount of apartments in 19 years. And 75% apparently have some form of defect. So is it a market you want to probably stay away from? I would be a big believer in just rent an apartment. I wouldn't buy one. But therefore, the same goes for lending. If we think like that, it's generally the same gist across the market. So if you're going to buy apartments, you want to be making sure you're getting a really solid deal, that the building's probably one of the better quality and buildings and get it checked out very, very well. And you're going to need a fair bit of capital and a good amount of equity, really, if you're buying into most apartment buildings.
Yeah, which makes it sound as if, look, if everything's going well, that apartment market might manage to hold up or drift sideways. But if we get any trouble, let's look out in that area with a huge supply coming on. And
well, that's the thing. Why would you pay? In these some of the older, better quality buildings, you might have an apartment for $3 million. You got a brand new one going up in 6 months where you can redesign it, do everything for the same money, and then 6 months later there's another one. So it's so much more dense than buying one house in a street that's not got any other houses going up because it's an established neighbourhood. So you're always going to have this sort of price constraint and restriction and real fluidity in the values, subject to what's going on, what's going up next door, because that's going to stop you buying. Therefore, you've got to start accepting big discounts to move your properties.
Yeah, so, Stephen, you mentioned in a similar vein, so obviously seeing the tower cranes up and docklands. In your experience, just with the deals that you're doing, have you got some sort of, I guess, pro and con locations, looking more at the geography of where, what the property market's sort of up to at the moment, where you're seeing some interest and where's it tough?
For apartments or in general?
Let's move away from apartments.
Yeah, okay,
just
because I can't see much positive in apartments. So in general, obviously, we've seen since the election, there has been an uptick in the property space, but it's realistically up to that sort of $1 million price point as a rule, and your really good suburbs. Your sort of Collingwood's inner east suburbs are still punching well above their weight. You've seen reserves that are going well over at auction. And that sub $1 million your investors are back in. They're buying, first-time buyers are getting back in because they're all in a hurry.
And it sounds as well as there's competition about going, well, I was thinking, maybe would I spend $900,000 on a house or $900,000 on an apartment? It's a house.
Yeah. Absolutely. Because with all the issues going on with apartments, you're not going to want to be there. Yeah. We have a fair bit of confidence in the super high-end market. The above 10 and the above even 20 in Sydney is super solid.
Wow.
All the feedback from Asian, a lot of Asian money that will still buy these, and they'll pay $1 million over the odds just to get it. So not that that's where most people play, but that market is very, very solid.
And do you think a decent chunk of that's the problems in Hong Kong?
Yeah, there's a lot of money coming out of Hong Kong, especially into Sydney. Currently, a lot of the agents are quite pushed by that, especially Double Bay, certain areas people are looking at, which was already getting full of a lot of Asian money, and now Hong Kong money is looking for a home.
Coming
There's a lot of problems there.
Yeah, I mean, I saw there's a survey out in the last week. There was one that people they're surveying Hong Kong about where are you going to go, and I think 50% had said Taiwan, and then Australia was next at 30%, and the US was like 10%.
Yeah,
like that sort of. And this was those numbers don't the numbers added up to greater than 100 because it's like saying tick all the countries you would go to, but it was just incredible that 3 times as many people from Hong Kong are going, where are you going to go? I'll go to Australia rather than the US.
Absolutely, and I can't see Hong Kong issues getting a lot better very soon. So that's going to continue to happen. So you're going to have that inflood of money. But back into Melbourne, sort of 2 to 6, 7 is very hard. It's a harder market still to move. Unless you have obviously its owner occupied space. People are generally just still sitting on their hands. I think people buying in that space are more worried about the economy than necessarily just buying houses. And if you look at the macro picture of around the world, there's a lot of issues that are going on. And I think first-home buyers are rushing in just to get in because they don't want to miss out on if the property's going to go up by another 50 grand. They want to get in now. Some shrewd investors and people that'll buy, but generally that bigger dollar stuff, people are still sitting on their hands.
Interesting. And just on that, do you do any sort of non-metro deals, or is there sort of anything in the regional space? If you just comment on that.
We lend Australia-wide, number one, and we say we consider every deal because every deal can be a good deal on its merits. But generally, major regional is where we cut out. So we'd lend in Ballarat, we'd lend in Bendigo, we'd lend out Traralgon Way, all that sort of stuff on standard resi or commercial or a small sort of farmlet. We're not into your 200-acre land sites or farms. It's just not our space. And the rate we would have to charge for it makes it fairly unviable generally for the borrowers.
Yep.
Having said that, if someone had sold their property and they just needed money for 3 months to pay out some version of a debt, they might have an ATO debt they owe or something like that, then we might come in and advance that money because that would make sense to us that we're in and out fairly quickly. But we do lend across Australia. Perth is pretty hard still. Poor old Perth has been struggling for a long time.
Yep.
We still don't see much going on there, but we generally feel it's at the bottom. So a conservative lend on a conservative value is not a bad deal.
Yep.
You've got Adelaide and certain areas that are just put along pretty standard. They don't go too crazy up and they don't go too crazy down. And then the majority of our capital is out on the East Coast.
So Brisbane, Gold Coast? What's your...
We will lend in Brisbane, Gold Coast. Gold Coast has been...
You certainly hear a lot about apartments being pretty tough up that way.
They have been, but in the last sort of 24 months, have actually been relatively solid. If anything, that Queensland has performed better than Sydney and Melbourne, obviously, with the decreases that Sydney and Melbourne have seen. But Brisbane is probably the Brisbane apartment market has always, but last year has been a problem. Been a massive oversupply. And the apartment prices have been dropped dramatically. We've heard whole buildings being sold at 50% of the price they really wanted just to move them on. So Brisbane we've stayed away from quite heavily. Gold Coast actually been pretty good. Decent, generally again, older, better quality apartments, view of the water. There's a lot of people moving from Melbourne and Sydney moving up there. A lot of the great nomads are all going up to Queensland because look at the weather, right? So there is a bit of money moving into Queensland from the southern states, which has kept Gold Coast actually going all right this time around. Everyone thought it was just going to go right through to the Commonwealth Games, but it actually did continue to go quite solid after that as well. So hasn't been too bad up there.
Yep. Okay. Fantastic.
On the political side, so we had this Royal Commission, irresponsible lending, or lending that didn't conform to responsible lending laws, and this whole big pullback from the banks, and then we have ASIC lose its case to Westpac, and our Treasurer and Prime Minister saying we've got to get credit flowing to the economy. So, I guess within the people at banks, how I guess you're facing sort of two bits. One is a judge is coming up saying, "Hey, what you're doing was illegal." There's potential criminal cases for it. On the other hand, you've got a treasurer and a government saying, "Get out there and lend as much as you possibly can." Yeah. Where do you think the fear greed gauge is?
And then you've got the ACCC getting stuck into them now as well for their interest rates.
Yes.
So you wouldn't want to be a CEO of a bank outside of the pay. It's a hard thing to juggle because you do have the media and the government pushing, saying, got to lend money, you got to pass on rate reductions, you've got all these things. Then you've got the business side saying, well, hold on, we're also here to make profits and support shareholders and run a business. And then you've got court and ASIC saying, be very careful what you do because we're going to come after you if you do it wrong. It's a very difficult space to play in. Yeah. And that's generally the vibe that you get from most of the more sort of senior reps that we deal with in the banks. They want to lend money, and generally the banks will come out. And if they are now coming out with a new product or a leniency on something, it's generally got a business taint to it. Yep. Because it does then skirt them outside slightly, or at least having to answer with ASIC if they want to try and buy up more debt. But realistically, everyone is more worried about ASIC and the judge than what they are about the government.
Yeah.
At the end of the day, they're going, well, hold on, these are the guys who are going to smack us with fines and we're going to have major problems. The government can rattle off as much as they want. We've got to deal with these guys and they've got the bigger stick.
Yep.
At the moment, and that's what you're seeing. You're not seeing, even with even with interest rates dropping, still not rushing to lend money. It's still very difficult for average Joe to get a loan. The amount of questions getting asked, the amount of in-depth analysis of your bank statements that is happening is far and beyond anything that ever used to occur. Yes, if you have not a lot of other things going on in your life and you've got your 2 pay slips and you can do it, you'll probably get your loan just okay. And you may be able to borrow a bit more money because of the lower interest rates, which is a whole other issue in itself. But the facts are, as soon as you step outside of mum and dad payslip, you're self-employed with a business, wanting access capital, it's very difficult. even if it's just for your home loan, it's very difficult. The amount of financial data they want, which is all answering to the responsible lending guidelines that have been laid out. And the fact that no one technically knows how hard you're allowed to go. Because it's kind of like, well, we'll give you all these guidelines, but, ultimately the judge will decide. Yeah, well, thanks. Okay. I'll try and make the best call. Yeah. And everyone's just sitting back. And that's a lot of the problem. It's a very hard one to judge. And when's it going to end? I don't think it will. It will just obviously decipher itself, and certain banks will start doing certain things and see how long they can get away with it, and then the other ones will jump on board. But it's a tough play at the moment. And
do you think, in terms of this whole demand-supply issue as well, is that there's a lot around saying, well, yes, the clearance rates on auctions and all these other things have jumped, and prices have certainly jumped, but it's all on very low volumes at the moment because the supply just isn't there for land. Sorry, not for land, for houses.
For houses,
Do you have any feel on whether that's starting to, I guess, at the ground level, whether that's starting to free up a bit, or is it still most people sort of sitting on their hands?
Yeah, I think that's a good point. Like, a lot of people saying, "Oh, the clearance rates are up," which is great, but the supply is half of what it was. So you'd want your clearance rate to be up there a fair bit. But the scary thing is our clearance rates are only up because our interest rates keep getting lower and lower and lower. What happens when they can't keep getting lower is going to be the real question. It's all artificially pushing the prices up. Still, is it going to continue trending up? Our feel from most of the agents we speak to that are quite realistic, not just on the sales side of things, is it's going to be just a few more bumps in the road going up. It's not really going to be a whole nother. We're not looking at another property growth a spike for 2020. If anything, we just had this boom since the election, which started, and it's continued with a bit of good grace with a few lower interest rates. It's not going there's no other reasons why that's going to continue to go up. There's still a lot of fear, and most investors that have been around there are actually very concerned about what's going to happen. Right? Super low interest rates, nowhere else to go, share markets at all-time highs, Donald Trump doing what he's doing in the US. There's a lot of concern that sooner or later something's going to pop. So I can't see real investors jumping in too hard into the property market through 2020 that's going to create exponential growth. I just can't see that.
And then, because I guess our sort of initial take was that a lot of this was just sort of pent-up demand in terms of people who hadn't bought over the last year or two.
People were sitting because they worry about labour getting in.
Exactly.
Right? So then all those guys have jumped back in now.
Bit of a flush. And now you're going to say, well, we need another wave now, investors. Now, that might be people deciding they want to borrow 95% of their home as a first home buyer to jump into the market. I'm assuming that you wouldn't be particularly comfortable lending to somebody on a 95%.
Yeah, that's not our space.
That's the federal government space. That's
the bank of the government. That's for sure.
Yeah.
And it's look, at the end of the day, people have got to get into the market if that's what they want to do. The Australian dream, right? Everyone wants to buy their house, but long-term averages of interest rates is a concern if you ever think they're going to get back there. Because if you're borrowing 95% and you're borrowing it with not a lot of money left in the bank every month, and you're borrowing it at 2.9%, what's going to happen if that rate ever hits 6? Now, I can't see them going up for a hell of a long time.
I think that was limited to sort of 600 grand or something. Was that right?
The incentive. There is a limit on it. But still, a lot of people have borrowed up their eyeballs.
Oh, absolutely.
At a very low interest rate, thinking how good it is. But if interest rates go up, which again I can't see them happening for a long time, but sooner or later, that's where we're going to see major problems.
Well, and the other one we're watching pretty closely as a whole, is the employment side. So we're sort of going, I
saw that the other day.
And it's just that take on Perth. Perth had exactly the same credit conditions as everywhere else, but prices managed to fall over there while they were booming in Sydney and Melbourne because unemployment was ticking up, and it's just that whole, if that doesn't hold together, then you might want to keep your house, but if you haven't got a job.
It's pretty hard to pay for it when you don't have any income. So, and Perth was exactly that. The mining boom stopped. You're no longer getting 200 grand a year to drive a truck around, and good luck. You can't afford the debt that you've leveraged up, and it came off at a rate of knots.
foreign builders?
It was actually a question that was called in, knowing that you were coming on board. So it was just a question around foreign, and I guess, and you've mentioned Chinese, and there was some Chinese marketing company shenanigans in pre-orders as well. I guess over the last few years into the boom, and then obviously into the plateau and fallen plateau, have you had an experience in their input into the market and what they're currently doing now, Stephen?
Yeah, sure. So look, a little bit of a hard one for us is we don't really fund development. But we've all seen Chinese developers buying a lot of the assets out there, buying old properties that they're going to be knocking over and developing. And you saw a lot of the time where the Australian-based developer was pulling out of the auction. There was no margin left in that deal. He's no longer bidding, and it sells to a Chinese owner. We had a loan not long ago come in, and it was a Chinese investor, and they had something about 160 properties in Australia, and they're all heavily got a development taint on them all. So these guys were just buying up. But their ability to get capital is another issue. Well,
and I was just going to say, so if the local guys who know the market, obviously very well, are getting rubbed out on margin, then what's the incentive for? What's the Chinese back?
They need to get their money out.
They're just getting the money out. It's just a parking spot, essentially.
We believe.
Yeah,
generally it is. If you're no different to why are they buying the over $10 million house and they're paying $1 million over the odds just to get it. They just want their money out. They want it into what they would deem a safe asset. And if they pay a bit over the odds, well, so be it.
It's insurance.
It's in.
Money laundering costs you 20-30%. So if you can, if you just have to pay $1 million extra on a $20 million house, it's cheap.
Yeah. Okay.
So look, there's all that side of it. Their ability to get the finance away though is another problem, because they are generally a non-resident. They might have obviously their FIRB approval, subject to however they bought the asset. Getting the finance is a problem, because a lot of the banks aren't going to lend to them. They don't have, again, that track history. The second tiers may or may not, subject to what they can stack up. But if they've got the capital, they're not going to mind paying the extra rates. I would suggest not that we fund development, we see a lot of applications for it. I would say 1 in 3 would be an Asian borrower.
Wow.
That you see. Because they're trying to get a development away and they're happy to pay.
And they're looking locally. There's no
to get the funding.
Yeah.
Oh, look, when they come to us, they obviously are. There are quite a few Chinese banks and Hong Kong banks that are lending in Australia and doing some of this development finance. You don't generally see a lot of it going on because it's just not our market. They're using Chinese brokers, they're using Chinese banks, and we're just not in that space. You do hear of it. And we also deal with some Chinese brokers that approach us with these deals and say, it's just not our cup of tea. And they get some crazy deals sometimes. They get some super cheap money as well from overseas. But it's a very much a community that's generally stick together quite a bit. And we just don't play in that space.
And they haven't fled the market yet. Because we saw some, is it Rayland that fell over? And so you've seen, I guess, the issue with some of these, as you said, these people buying up lots and lots of property, and we saw it with Japan. So Japan back in the 80s, where came up to Australia, bought up a whole bunch of properties. You have a problem in Japan, and then all of a sudden
they want to get out.
They're all selling their Australian properties to take their money back to fix the problems they've got at home. That doesn't seem to be the case yet in Australia, even though we've seen a few falling over.
No, I don't think so. To be fair, the loans to Asian borrowers generally perform better than any of the other ones. So currently their backing is still there and they aren't needing it. Obviously, you're going to have the old one that falls over and that's the way life is. But as a performing book, and even if you look at outside of development, the non-resident loan debacle of a couple of years ago, where Westpac and a few other banks have written all these non-resident deals and they hadn't adhered to the NCCP when they wrote them, technically. All those loans, though, never missed a beat, right? They might not have, maybe their pay slips were created, but the borrowers never missed a beat. They're the best performing loan books you can get. They shouldn't have got the loan, but they don't miss. So it's quite intriguing how they managed to keep getting the money in and holding everything up.
Okay, very good. Well, look, I'm conscious of your time, and thanks very much for a terrific 50-odd minutes spent today. Would you mind just letting our listeners know how they can get in touch with you, and if there's any interest in what you guys are doing to follow up?
Sure, thank you. So look, if it's regarding the placement of a loan that may be needed more in the second tier space, if someone's got a debt that they need to pay out somewhat rapidly, they can check out Resicom at www.resicom.com.au. If you're an investor, investor or you need money as well in the more private space, then go to oakcapital.com.au. I'm more than happy to help.
Wonderful. Okay, well,
Thanks a lot.
yeah,
Thanks
thanks for
very
coming
much.
on. Cheers.
Excellent.
So, Damien, some terrific time spent there with Stephen Mitchell. Obviously got a lot of experience in an area of the finance and mortgage market that is probably not always as well known as it should be. So what are your thoughts?
Yeah, look, I always think this is a very interesting part to sort of peel back the cover on and have a look. And as you said, I think you get some of the guys who have been in the industry for a long time, and they get to see the cycles, and they get to see as conditions are easy and all these other people move in and go, isn't this great? Isn't here we can lend money and there's all this money to make from it. And then when the proverbial hits the fan is when the cockroaches scatter and you start seeing, the problems start to come about. And so it's very interesting to see sort of his views on where we are in the cycle and some of the I guess the differences we're really seeing. This really hasn't been a traditional property cycle. And I think of a traditional property cycle as, you start getting this extra lending and sort of at the bottom of the cycle, and then the extra lending chases prices higher because there's not enough property out there and nobody's been building, and then all of a sudden everyone starts reading about it in the paper and prices take another big leg up, and then you start getting some development start, but the development's lagged because it takes a couple of years to get on board. And so by that stage, there's this huge avalanche of lending coming and looser lending standards, and everyone's talking about how great property is, and it always goes up, and it doubles every 7 years. And then you get this. Then you start seeing the supply hit the market at the top.
Yep.
And the whole thing comes unraveled, and then banks sort of start going, just a minute, why did we lend on all those projects? Stop that lending right now. And then right at the worst time. So and then that's your property cycle. It falls over, and you go back to nobody lending on property, and then start again. And whereas Australia's really been messed up this time around. So what we've seen is we've sort of seen this bit where we've got this mining crash going on, which is affecting Perth, and the Perth properties are falling. But meanwhile, we've got this massive lending boom while banks are basically lending irresponsibly and using measures, poverty measures to assess everyone. And so we've got this huge influx of money coming into sort of the eastern states and pushing prices higher. Then we have we don't have a traditional crash. What we have is this Royal Commission starting to say, just a minute, you guys are lending irresponsibly. And it's like saying, well, we've sort of had we hadn't reached the climax yet. We've started pulling back on lending before we actually started to see the whole thing to come to a natural end.
Yep.
And so that's sort of happened. And then halfway down the fall, we've then had the government step in. We've had everyone's expecting a Labor government, and we've actually got a Liberal government come in, and they're like, we're supporting house prices. We'll do whatever it takes to keep house prices high. We've been voted in to not let your house price fall.
And then the RBA on top of that.
And the RBA cutting rates, and we've got APRA sort of loosening lending standards when they were sort of been told, hey, you guys have been way too loose on the banks, and then all of a sudden they're turning around saying, well, banks can assess their own risk criteria. We don't need to do it for them. And then we've got ASIC out there saying, well, we are going to take people to jail.
Yep.
Try and take people to jail. We are going to prosecute. And so it's this really messed up property cycle, and just getting a hang on where it is and where it's going. And to us, it very much seems as if there's not a lot of upside in it. So there's all these things being thrown at the property cycle to try and hold these prices at a high level as long as we possibly can, because people have voted us in for that.
Yep.
And we're shooting all the bullets that we'd use to usually save the housing market when you do have a crash. We're sort of shooting them early and so if we do have say an employment issue, the construction in particular is where that looks like it might start, and if that sort of blows everything off target, or we have an external shock for a trade war or Brexit or any number of dozen sort of different things that are going on internationally, then the Australian property market could be in real trouble. And so you're sort of looking at this part where you're going, if things can just hold together, we'll be all right, versus otherwise, there's a significant downside. And so what I found quite interesting in terms of what Stephen was saying was what he's seeing on the ground seems to add up with what we're expecting.
Yep.
Still, we're sort of not seeing anything dramatically different. That whhole part about developers just cannot get finance is a big issue, and that's where that employment side comes. Because I've mentioned during the podcast, but I'll reiterate it, is Perth had the same conditions, same economic conditions as the rest of Australia, except for a rising unemployment rate.
Yep.
some people go, oh, yeah, but they didn't have the same population. Perth had a big population inflow. They were growing at rates well above what you see in any other industrial country.
Yep.
Yes, it was below what Sydney, Melbourne was, but you still had a solid inflow into Perth. It wasn't about the population. It was about unemployment ticking up.
Yep.
And if unemployment ticks up in the eastern states, then we're in the same spot. And so the fact that developers still can't get that finance is where one of the main concerns for us is in terms of weakness in the economy. In terms of the lending part, it was interesting. I guess I probably what I didn't know was there had been as much expansion in his area, and that's always a concern. As you know, as he said, he's just standing back, going, "No, that's fine. I don't need that deal." But it makes sense so that people are chasing yield, and they just keep chasing yield further and further down the rabbit hole. And the idea that there's obviously a bunch of people out there who have done a bunch of lending, and then when you do get problems, they're like, oh, we actually didn't factor in the fact that maybe we need to go to court to get this money back, and that's where people start walking away from deals, and then you start getting those ones falling over,
distress sales, and
exactly, and that's where things can get can spiral out of control. And so so I guess, and then the other mess part of the property cycle is this whole apartments versus houses part, and he's again confirming what we heard from Catherine and from Susan Farquhar not long ago, is that area of the market that sort of, I don't know, you probably
2 to 8, I think you said, or 2 to 10 mil?
2 to 10 mil.
Yep.
Well, and it's more the ones where he's saying it's a sub-million market where everyone's interested, because it's that whole part about, well, I'm choosing between an apartment and a house. I'm not buying an apartment. There's too many problems with apartments. And then we've got this big wave of apartments just starting to crash onto the wave of supply starting to crash, and everyone's just going, no, that's fine, I'll buy a house. And so we're seeing that whole house, that sort of sub-$1 million house being bid up while we've got apartment prices coming backwards.
Yep, sure.
And so, I guess where I'm trying to get to with this is, this is not a typical property cycle, and it's really quite different. And I think anyone who's got certainty about where this is going needs to have a good close look at what assumptions they're making, because I think there's extremely uncertain, but at the moment for me, it very much seems limited upside, a lot of downside, and so we're playing it very cautiously.
Okay, very good.